Okay, hi, and welcome to Saxo's weekly market outlook call. I'm Charu, a market strategist with Saxo Markets based in Singapore. And today, let's get started with a quick look at the equity markets. We saw some key levels break last week, both in the S&P and Nasdaq. The S&P went above 4,300. Nasdaq was above 13,500. While we have seen a reversal from these levels, and we continue to believe that we were in a bear market rally, really, it is still potentially a time to understand how the cycle is different from the other high inflation cycles that we've seen in the past. So my sense is that even with the Fed's approach of remaining aggressive to fight inflation, they are sticking by their stand of giving minimal guidance. Which of course leaves the door open to any potential gear switching at any moment. So that is obviously creating a lot more volatility, and we could possibly continue to see more bear market rallies. But the overall trend will still remain down. We've had some of the speculative froth settle down as well after what happened in Bed Bath and Beyond last week. So that kind of helped the market to focus back on fundamentals as well, which is, of course, the deteriorating macro environment. Key to watch this week will be the US Treasury yields. If the 10-year goes back above 3%, that could again mean more pain for equities after what we've seen like 9 weeks of gains over the last months. From last week, I think important to talk about the FOMC minutes, which actually had little fresh impetus. For one, of course, they were stale. We had the jobs report and the CPI report come out after the FOMC meeting. So, of course, that wasn't really an input there. But two, again, the Fed is actually unsure of what the future holds. So they are staying away from specific guidance. Still, what was clear was that inflation will continue to remain high. It won't really magically come down to the 2% target next year. So there is a general expectation that rates will go up to restrictive territory. As per the Fed, they are at neutral now. So anything above this is technically restrictive territory. But in the real sense, financial conditions are easing. So we still have a risk of reflation, and that will mean that the Fed's job keeps getting tougher. Some officials signal that once rates have been raised to the point where they were cooling down the economy sufficiently, it would be probably appropriate to maintain that level to ensure that inflation was firmly on the path that they want it to be. So that's somewhat of a pushback again against easing expectations of next year. And in fact, very particularly, Powell has not also ruled out another unusually large increase in September. But again, let's wait to see what the next jobs report and inflation numbers bring. And the next FOMC meeting is only after those two numbers are reported. So we do have a lot of input to really make a guess at the September meeting's outcome for now. This week, the important event is the Jackson Hole Symposium. That usually throws up a few surprises. So that will be key to watch. We might get some more pushback on rate cuts for next year, which again makes us a bit more skeptical about the equity rally that we've been seeing in the past few weeks. We may be at a turning point there. So US data has been rather strong. Retail sales, industrial production, jobless claims, everything is suggesting resilience in the US economy. There were some concerns on the housing market last week, but nothing that could really derail the economic momentum. In fact, European concerns got a leg up last week again. We had the UK CPI touching double digits. July print was at 10.1%. And Friday, we saw German PPI, the factory gate prices, also being a big shock, 5.3% month on month gains in July versus expectations of 0.6. So that's a big difference, 5.3 versus expectations of 0.6. And we have this week the PMIs due in Europe and UK, likely to make the stagflation threats get louder. And in terms of the market impact, it does look like euro dollar is heading towards parity pretty soon. Sterling also took a brief look below 1.18, but the year's low of 1.1760 is now pretty much in sight. So dollar gains overall have been a big story last week, and we think that has room to run further this week if we do see that US 10-year yield getting above 3% and possibly staying there. In fact, yen could be a big mover as well. We could see 140 getting tested if we do see that a move in yields above 3% getting sustained. CNH, the Chinese yuan, has been a big story this past week as well, but I will leave that discussion to my colleague for later. And let me now switch gears to commodities, overall softer due to the dollar strength. Besides, of course, the European gas prices, really, which continue their run higher. Crude oil, but we think is at a turning point. There are fresh fundamental supports, such as the European energy crisis, which keeps getting worse and is accelerating a shift to oil from natural gas. Also, supply side concerns have remained elevated, not least considering the soon to expire releases of the crude oil from US strategic reserves and the EU embargo of Russian oil fast approaching. There may be some downside pressures in my sense, at least earlier in the week, because the focus is turning back to Iranian supply. The deal is getting closer to being locked. But overall, we do maintain our $95 to $115 price range forecast for crude oil for the third quarter. Lastly, I think I will just touch upon gold and silver, which are really struggling. Gold reversed back below 1800, below 1750 actually, and silver is also below the key support at 1950. There could be more short-term pain again if we do see that move in US yields and US dollar higher this week, as we've talked about. But again, if you believe that inflation could be higher for longer, then this reversal in gold and silver may as well be viewed as buying opportunities. And I'll stop there and hand over to Redmond.
Hi, morning everyone. And yes, I just want to pick up from Charu on the US dollar CNH. And in last weekend's the PBOC, when they did the onshore fixing, they allow it to fix at a high level, and they fixed it at 6.8065. That was actually higher than the May fixing, so that triggers some market nervousness. And also, and given the the strength of the US dollar versus all the major currencies, and the very weak credit data the week before, and also the weak economic data and the resurgence of COVID outbreak and the surprising rate cut, I think that's very important by the PBOC. And although that has driven down Chinese government bond yield to the lowest level, so that is all these have contributed to a the weakness in the renminbi. And on Friday, the US dollar CNH and reached as high as 6.8445, and that was actually a level. It's almost the 2-year high, and now trading at 6.84. And so it's now I think the market is quite watching whether what PBOC will do, whether PBOC will allow the US dollars, the renminbi to gradually weaken towards the 7 handle level, and that's psychologically important. And I think that's the market, the market watching. And people will also take notes on the long prime rates that will come out actually literally in 6 minutes from now. And that is what the China's National Interbank Fund Center, they survey all the major bank, and then they do the fixing. But of course, that's under the PBOC's guidance. And after the last week's 10 basis point rate cut in the medium term lending facility, now the market is expecting the LPR for the 1 year and the 5 year most likely will be cut by 10 basis points as well. But there are some traders and also watching whether actually that especially for the 5-year LPR, whether the PBOC will allow the fixing, the bank to fix it at less than more, actually a reduction of more than 10 basis points. So is that if that's important, because in China, mortgages loan benchmark to the 5-year LPR. So that will give a signal to the market is how eager probably that the PBOC is to support the housing market. And one thing about along that line, and last Friday, it's on Xinhua News, there's a report saying that the Housing Ministry and the Ministry of Finance, and together with the PBOC and with the direct involvement of PBOC, and they jointly roll out some new policies. One of which is they will make special loan through the policy banks to support the delivery of those PSO residential housing projects. And basically they will lend to some of those developers who are in trouble in getting the money to finish, to complete the project. And but the report has not elaborated, is how big is the size. So this week, I think the market focus will be to see whether there's anything more coming out from how big is the size of the program. And also, and because the PBOC is already involved in initiating this program, and even though if through the policy bank, is now widely expected the PBOC probably will actually print money to give it to the policy bank for this program. So I mean, these two things, the size of the program and actually whether PBOC will be printing money or to give it to the policy bank instead of asking the policy bank to raise the fund themselves. And that will are the two key things, and see how important this initiative will be, how significant the impact will be on the housing sector. And also we have since the week before, we have the resurgence of COVID cases in China. Throughout the last week, it's above 2,000 every day new cases, and especially Hainan, Tibet, and Xinjiang. And now that sort of creates some kind of nervousness. And and another thing is that add to the headwinds now the Chinese economy is facing is the because it's where the heat wave in China now is actually most severe and in the last 60 years. And so it's in many places, and temperatures is above 40 degrees Celsius. And that create, of course, number one, and that will incur more air conditioning demand for power, for electricity, and also there's a drought in China, and so the high temperature together with the drought also will hurt with that will reduce hydropower output. The two things together that has actually hurt those provinces, particularly relying on hydropower, and like Sichuan. And Sichuan is curbing electricity supply to industrial user in order to ensure electricity supply for residential use. So the COVID cases and the power crunch and the weak data and the weak credit data as well, and actually had triggered a number of analysts and investment bank cut their forecast for China's GDP for the whole year to 3% or even below 3%. And so that is some of the headwind I would like to mention. And of course, it's during the power shortage, and the coal mining company and all the electricity producers, they have been doing very well last week, and so probably they will. I think that will still draw a lot of investor interest into these two sectors. And this week, and those coal mining company and electricity utilities. And then that's pretty much all for me. Just one thing, maybe I should also mention. There's a review of the Hang Seng constituent stock, but I think I'm not trouble you here. You can actually read it from our notes.
Thank you, Redmond. David Harvey's my name from Sydney, Redmond from Hong Kong, and Charu from up there in Singapore. It's a good segue. Obviously, there's a lot of information that was covered there on that call. Commodities, currencies, bonds, heat waves, you name it. So what we do here at Saxo is obviously put that together in a note, and you'll see that on your inbox. You'll also be able to find these insights on the platform. But I think most importantly, with these salient and prescient insights, and obviously the fluidity of markets at the moment, we really thoroughly encourage you to have a conversation with your relationship manager. So with that, we return you to your day. Thank you very much.
Happy trading week. Bye bye. Stay
Happy trading
safe.
week.
Bye.